Welcome in this video. When will Xcn coin end? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. A careful examination of the chart reveals that the current price action is trending below a distinct descending trend line. This type of structure is one of the classic technical analysis patterns that usually indicates continued downward pressure in the markets. Lower highs and lower lows over time suggest that sellers are still in control of the market and buyers have yet to muster enough strength. At the moment, traces of a long-running downtrend are clearly visible on the chart. An upside break of this trend could signal a significant technical change. This descending trendline is a structure created by combining the resistance levels that the price encounters every time it attempts to move higher. It also indicates that the general perception of the market is negative and investor psychology is still cautious. However, such downtrends cannot last forever. Over time, this structure weakens and reaches a breaking point as market conditions change. This line becomes an important technical barrier, especially if the price has touched this trendline more than once and failed to break it. Breaching this barrier to the upside is perceived by traders as a turning point. Breaking a downtrend is not just the crossing of a line. It is also an indication that the psychological dynamics underlying price action have changed. Once this line is crossed, traders adopt the perception that the decline will no longer continue and update their positions accordingly. Especially if there is also an increase in volume during such breakouts, this means that the buying movement is strongly supported. Volume-backed breakouts can often be the starting point of long-term uptrends. In the current situation, the price is quite close to this falling trend line. Looking at the last few candlesticks, it can be seen that the price retraced each time it touched this line. However, the strength of these pullbacks has been gradually diminishing, and price has been making higher lows each time. This is called a squeeze in technical analysis, and is usually a sign of a strong move. If the price breaks the falling trend line to the upside as a result of this squeeze, this could be considered a trend reversal and pave the way for the price to reach higher levels. Breaking downtrends often heralds not only short-term, but also medium and long-term changes in direction. When this breakout occurs, previous highs become targets in sequence. In other words, after a breakout, the price may first test the recent low, and if this level is passed, higher targets may be on the agenda. One of the elements that traders pay the most attention to in this process is the retest after the breakout. That is, the price should go back to the falling trend line it broke, find support there and resume its upward movement. This retest is very important to distinguish whether the breakout is fake or real. One of the most effective strategies, especially on falling trend breakouts, is to enter the position after the retest. This is because rushing into a position during a breakout can sometimes lead to falling into a bull trap. However, if the price retraces and finds solid support at the broken trend line and reacts upwards, this confirms the start of a new uptrend. A downtrend break is also important in pattern-based analysis. For example, a downtrend breakout sometimes indicates the end of patterns such as descending triangle, pennant, descending wedge. This confirms the same bullish scenario from different technical angles. In such a scenario, investors feeling psychologically safer also increases the upward momentum of the price. Another factor to note at this point is the time factor. Trend lines are not only price dependent but also time sensitive. Some trend lines weaken over time because market perception changes, economic data is updated, fundamentals change. But we can't decide on analysis based on trends alone. Let's look at other metrics. Stay tuned. A careful analysis of the chart shows that the price is currently approaching a rather critical level. This is an important horizontal support zone that has been tested many times in the past, with buyers coming in strongly at each contact, interrupting the downward momentum of the price and acting as a floor. Such support levels are areas in technical analysis where investor behavior crystallizes and market psychology is significantly reflected. The fact that the price is currently moving just above this level suggests that the market is approaching a moment of decision and possible changes in direction are at the door. This support area is technically meaningful for both short-term traders and medium to long-term investors, because the previous price reactions from this level have created a strong perception for investors. When the price gets here, it stops falling and turns up. Over time, such perceptions turn that level into a line of psychological support. For this reason, as the price approaches this level, buy orders intensify, and many investors open positions with confidence in this area. However, it should be remembered that not all support levels last forever. At some point, market dynamics change, volumes fall, momentum weakens, and if the support level is broken, this could trigger a new wave of declines. The current technical outlook shows that the price has approached and tested this vital support area several times. In each test, the support zone worked, albeit temporarily, and the price reacted to the upside. However, if each reversal is weaker than the previous one, this indicates that support is eroding over time. In technical analysis, this is called a weakening support structure, and such structures are usually more prone to breakouts. Therefore, in the event of a retest of this level, traders should pay attention not only to the price, but also to how this test is taking place. For example, is volume high? Is momentum strong? If the support level is broken, this is interpreted as a significant technical breakout. Such a scenario could trigger a process where the price will start looking for new supports at lower levels. Especially if this breakdown is accompanied by strong volume, we can say that the market has accepted the downward pressure and sellers are in full control. In this case, the price may continue its decline to areas such as previous lows or Fibonacci retracement levels. Moreover, this breakout is often considered by technical traders to open short positions, as it increases the probability that the price will fall further down to the lower support zones. Upward rebounds from the support level can often last until the previous resistance points. This can create a significant return potential for investors in the short term. Such a reaction rally can also sometimes cause the price to break the downtrend completely and start a new uptrend. In this respect, it should be noted that the support level should be considered not only as a floor, but also as a trend reversal zone. Also, if the price reacts upwards from this support and starts to form higher lows and higher highs in its subsequent movements, this is considered the beginning of an uptrend in technical analysis. In this case, there is also a psychological turn in the market. Traders no longer expect a decline, but an uptrend. This leads to both an intensification of buy orders and a decrease in selling pressure. Another reason why such support levels are important in technical analysis is that they are usually defined based on previous price movements. In other words, there may have been heavy trading volume in this area in the past, there may have been excess demand, or this area may have been the bottom of a previous correction. All these factors make this level more technically meaningful. Therefore, the price coming back here, and how it behaves at this level, is closely related not only to current market conditions, but also to past price behavior. Breaking or working the support level has important implications not only from a technical point of view, but also in terms of investor psychology. For example, when support is broken, many traders may be forced to close their positions with a stop loss. This would increase selling pressure, and the decline could accelerate. Conversely, if support holds and the price quickly turns upwards, this reassures traders and may start a wave of buying again. A closer look at the chart analysis reveals a very significant uptrend structure in the RSI indicator. This rising trend line suggests that the RSI values are forming higher and higher lows over time, and that buying power is gradually increasing. In technical analysis, such uptrends in the RSI usually indicate that the price has positive momentum, that the market is supported by strong buyers, and that the upside is healthy. A breakout of this structure, however, not only means that the RSI is changing direction, but also gives a critical warning that the price may also come under pressure, and a bearish scenario may be in play. Such RSI trendlines usually indicate that traders' confidence in the market is gradually growing, and with this confidence, buying trades are gaining volume. A higher RSI level at each new low indicates that the selling pressure in the market is weakening, and buyers are gradually gaining strength. This structure is also interpreted as a positive momentum curve in technical analysis. However, when this trendline breaks, the situation can be completely reversed. This is because such structures are not only a reflection of past prices, but also a preliminary signal of potential future changes in direction. Breaking trend lines, especially on oscillators like the RSI, can be a harbinger of an impending breakout or correction, even if there is no obvious reversal on the price chart yet. A downward break in the RSI leads to a significant break in investor psychology. It indicates that the market is losing strength, buying momentum is waning, and sellers are starting to regain control. This, in turn, may trigger a price retracement to lower levels. In such cases, a trend break in the RSI is the first signal on the radar of technical analysts, even if there is no visible break on the price chart. This is because the RSI is an indicator that usually moves in front of the price, not behind it. So when the RSI breaks the rising support line, it could mean that the price will similarly react downwards in a short period of time. Such signals are important warnings for traders who prioritize risk management. With a break of the rising trend line on the RSI, the price may also be suppressed in the short term, and lower support levels may be tested. RSI should not break this trend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.